The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. I'm Michelle Hebert, Director of Communications here at Saney's, and I want to welcome you to another Lunch and Learn in our Financial Friday series. Saney's is excited to offer these sessions in cooperation with our corporate partner, AXA. AXA has a long-standing presence in New York, and a large portion of AXA's New York client base is built upon the work they do within the public education system. Through AXA, Saney's members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for Saney's members. And that's a great benefit. We urge you all to take advantage of that. Our AXA presenter today is Alex Bonaco, Vice President for AXA from the Western New York area. Now, before we get started, please note that all participants are muted during this session because there's so many of you on. But we will have time at the end for Q&A. To ask a question, simply type your question in the Q&A box in your control panel, and we'll get to everyone after Alex's presentation. Also, this session is being recorded and will be posted on the Saney's website, and we'll email you all a link to that after the presentation as well. So with that, I'm going to turn the presentation over to Alex.
Great, thank you very much, Michelle. So as everyone can see on the screen here, again, the topic will be Social Security and hopefully getting the most out of this benefit that we're going to talk about here today. So we're very happy to be with everyone again for this Social Security portion of our webinar series. And some of the things that we're going to touch on today in regards to Social Security is going to be really understanding the value that Social Security is going to bring to individuals and families throughout their retirement lives. Looking at the solvency of it, or really the health of Social Security, there's a lot of different options of when to begin taking benefits. I know these days there are a lot of people who do want to retire and still continue to do some work in retirement. And what does that mean if you're actually receiving benefits from Social Security as well as earning some income? And then what are the different ways to manage these benefits from Social Security? There are a lot of different ways to do that. There are a lot of rules in this, we'll call it Social Security rule book. And just like any rule book, all the rules are not there to kind of pin you down. So if you do know the rules and you can work with people who know the rules, you can really take advantage of this awesome program that we're going to dive into right now and really just talk about what Social Security is. So I think we all know here that it's a government-sponsored, inflation-adjusted lifetime retirement income vehicle. So there's no guarantee that the future program will operate as it always has in the past, but this presentation will explain Social Security's present financial condition and hopefully give some education out there for everyone that's on board here today of different strategies that they can potentially use to help maximize these different benefits here. So I think there's a misconception over the value of Social Security. So if we were to take a quick look at this and talk about the income that this actually brings into the household, it's income that, first of all, you cannot outlive. It's income that does hopefully help keep pace with inflation, which we'll talk about here in just a little bit. It does provide survivorship benefits for spouses. And again, I think it does provide more income than many people might think. So the maximum benefit in 2018 is $2,788. And if you look at a 10-year time frame of that, that's almost $390,000. And looking at a 20-year time frame, $864,000, and then a 30-year retirement of that collection is basically like retiring and pulling from a retirement account over $1.5 million. We're going to continue on just to look at how these calculations are actually made. So I don't want to get too much for today's purpose into the nitty-gritty of how these calculations are made throughout the years of someone's working life, but basically, if we look at this thing, what you get out of Social Security is really based on how much you put in over your working life. So it's based on a formula that looks at what was earned and put into this Social Security system during a person's top 35 years of working. We can look at this, formula and the AIME, but really the important thing to know is that it's designed to give greater benefit as a percentage of what was paid in for those who had lower wages during their lifetime than for those who made more money throughout their lifetime. So now that we have a little idea of how this Social Security works, how do you really estimate of a good amount that you can kind of count on in retirement? So I'm sure here everybody might recognize this Social Security statement. Generally speaking, you've been receiving this about 3 months before your birthday since you're about 25 years old. And this statement is probably the best way to get an idea of how much you'll receive in benefits. But you can also go to the Social Security website at socialsecurity.gov or ssa.gov. Both of these addresses will get you to where you need to be in order to go to a link that will say estimate your retirement benefits. And that's going to be on the left-hand side of the page. So when we look at these estimated benefits, there's a couple numbers that pop out here. When we take a look at this first number here, $1,604 a month. So that would be if somebody started collecting at age 62. So no matter when you choose really to fully retire from work, you may start receiving benefits as early as age 62. However, if you choose to start at 62, the benefits are reduced for the rest of your life. So we'll discuss the ramifications of this here in just a moment, but moving forward here, this 1,543, this represents how much this worker will receive if they wait until full retirement age, also known as a normal retirement date. So depending on which year you were born, you may have a different full retirement age or normal retirement date than somebody else. So it's very good to take a look at this stuff, and we're going to talk about some other ramifications again of potentially taking money at age 62 or at any point really before that normal retirement age. So if we actually fast forward and said, what if somebody held on and waited until the age of 70? So you could see that the benefit is nearly twice what you would have received if you would have started collecting at age 62. The fourth arrow here, this actually represents how much a surviving spouse can expect to receive. And again, this is all easily accessible by logging online and looking at your Social Security statements that do come in the mail. And then finally, how much you will continue to earn between now and when you retire. So in this case, we're assuming that this worker will continue to earn about $42,000 until retirement age. So in short, if you earn substantially less than the numbers that are shown here, then your numbers will be less. And if you earn a lot more, you may receive even higher benefits. So we're going to keep moving on here and hit on just our Social Security estimating benefits with our earnings record. So page 3 of the statement that comes in the mail is really just a history of your earnings. Just really quickly on this, we have seen a lot, actually, a lot more than it should happen. These numbers wrong on people's Social Security statements. So this is something that you definitely want to at least look into and hopefully get some good ideas on and estimations of what's going to be coming, and that they're really calculating all of this right. And I'm not saying we have to do all these different calculations that we saw in these earlier slides here, but most importantly, just this earnings record. By year after year, does anything look way off? And if it does, you want to try to get to that before you start to retire, and then banking on taking the Social Security, but then there needs to be some rectifications done. So let's talk about spousal benefits here for just a couple of minutes. So if somebody did not go out in the workforce and earn a paycheck to the point where they were putting in money to the Social Security system, there is a way for them to continue to get Social Security when they do retire. So the easiest way to think about this is any spouse can take the greater of their benefit or half of their spouse's benefit. And when I say half of their spouse's benefit, I'm not saying that, you know, it's affecting that spouse's benefit at all. They're not taking money away from them. But if let's just look at Bob here, his benefit is $2,200 up on the top right. And let's say Sally did not have a lot of earned income years and putting money into the Social Security system, where her benefit is $700. Sally will actually get the greater of her $700 or half of Bob's benefit, which in this case would be $1,100. There are a lot of different ways to play this game when it comes to collecting spousal benefits. You can collect off of your own. You can collect off of a spouse. You can, you know, have one spouse collect and one spouse delay. The theme of when we're talking about Social Security here, and just like some of the other presentations that we've seen, whether it's, you know, retirement planning, New York State pension, not one of these things of our retirement landscape can be looked at in a vacuum. And so much has to be put into making sure that our Social Security matches up with our need, matches up with our tax situation, matches up with our New York State pension and what else is going on in the household. So all of these, you know, different topics here that we're talking about, they should be looked at together. And especially with this Social Security, again, we've put so much time and money into this system over the years, we might as well try to get as much out of it that we possibly can. Okay, so moving on, some more survivor benefits here. I think we kind of hit this already. I know this is a big factor here, and a lot of myths are out there in regards to Social Security and the solvency, or, you know, the relative health and stability of the system. But just some key sort of figures. In 2011, Social Security paid out more than it collected. In 2020, Social Security is tapping into the principal of the trust fund, and in 2033, the trust fund is set to be exhausted. So if no changes are made in what's being put into the system and what's being paid out from the system, the following will occur on these dates. But just because something means it's exhausted, it doesn't mean that it's bankrupt and there's no more money to go around. And that's where I think a lot of the confusion sometimes arises, is that the trust fund is exhausted, but Uncle Sam still collects taxes, right? And a portion of those taxes will continue, just as they do today, go into the Social Security system, and therefore there will be money to pay out the benefits. But the problem is it might not be enough money to pay out what everybody right now is expecting. We'll just speak maybe from our group standpoint here. We do feel that if somebody is getting close to retirement, you should be pretty confident that what you are expecting to get from Social Security, that you really should get that. It's maybe for the either the younger generations out there, where they can change a couple of things that we're going to talk about here in a second, but really the projected benefits as of 2033 would be decreased if no changes are made. But we do think that there will be some changes put into place from now until then. Okay, we're gonna fast forward here just for a couple slides. This is just looking at some stats from 1940 and then in the range of this time frame right now. Just a quick stat here. Payroll tax rate was 2% in 1940. It is now 12.4%. The earnings cap for Social Security tax was $3,000. Now it's $127,000. Total beneficiaries in 1940 was just under 250,000. And now we're over 61, I'm sorry, just under 250,000, yes, and now we're over 61 million beneficiaries. The worker to beneficiary ratio, this is sort of a crazy stat here. So in 1940, there were 159 people working putting money into the Social Security system for every one person that was actually collecting a benefit. And now that number is less than 3 to 1. So we all know people are living longer these days. Obviously, that has a lot to do with this. And really, that's one of the issues that Social Security is dealing with, is just the longevity of life. And it's something that was not planned for. So the average retiree benefit, again, back in 1940 was $22 or so a month. And now it's about $1,300 a month. So what are some of the things that can be done to help fix this Social Security issue and to really make sure that it's there, again, for everybody, not just the people who are in retirement or about to retire, but hopefully for all of the generations out there? So I think one of the easy things that can be done is just raise the retirement age. So if we think about, Social Security and money being paid in and money being sent out to, being paid in benefits, if they just raise that normal retirement date, especially if people are living longer potentially, that's one way just to keep money in the program and not going out for so many years. They could increase the cap on taxable earnings. So we just hit that. I think it was about, let's see right now, 127,000 this year. If somebody makes more than that, there's no more money going into the Social Security system from that person's income. So they could increase that to say, hey, no matter how much money you make, or we're going to raise it from 127 to 200,000 or 500,000, or truly put no cap on it. That would be just another way for them to continue to bring in money to this Social Security program. They could potentially lower the benefit payments for future retirees. And then the last is they could, look to reduce the cost of living adjustment for all retirees. And that, I will say, is something, it is so subjective of how they give these different cost of living adjustments. If anybody on the phone call here today has received benefits over the last, we'll just say 5-6 years, there was actually a time frame where a couple years went by where Social Security did not give any sort of pay raise. When I know that things did go up in cost throughout that time frame. So it's just another way that, unfortunately, these things can be not so set in stone. And year after year, you don't really feel it a ton, but just thinking back of, there are probably people on this call today that have bought a car recently that's probably more expensive than the first house that they bought. And that's where this inflation in retirement is something that it's so important to keep up with and so important to be aware of. And that's where, again, this whole entire retirement planning landscape comes into play, where, especially for everyone on this webinar today, you have your, let's just say, New York State pension. I think last time we talked about how the cost of living adjustment works inside there, which, long story short, it's not anything major, maybe $300-400 a year at the most, no matter how big your pension is. And then you add on Social Security, another fixed income, which this also mathematically and factually does not keep up with inflation. The first few years in retirement, you really don't feel that as much. But when you go out 5, 10, 15, 20, 30, 35 years in retirement, when you continue to get, we'll just call it basically the same paycheck from these two fixed income streams, but your costs are going up every year just to keep the same standard of living, it's those other accounts that are put into place, the 403Bs, the IRAs, the Roth IRAs, the 401Ks, looking at, again, these accounts as a household sort of feature. It's those that bridge the gap to allow somebody to continue their same standard of living throughout retirement, because, again, these two fixed income sources, they're not really going to do it over the long haul. So when to start taking Social Security? And I know we're getting a little close here on time to leave some minutes open for Q&A. So let me just check here. It looks like we have 12:20. Michelle, we'll just go for 2 or 3 more minutes if that works. If not, just chime in at any point. But when to start taking Social Security? So again, going back to that normal retirement age, it's for most people right now 66 or 67 years old. You can take Social Security at 62, but for every year before your normal retirement age, you reduce your payment by somewhere around 7 or 8% for the rest of your life. So with increased longevity, right, and the longer you hold on collecting from Social Security, at some point there's a break even. And that means, hey, I can take my Social Security at 62. Yeah, I know I'm going to get less money for the rest of my life, but if I waited until I was 67 or 70, I'm going to get less money, or I'm sorry, I'm going to get more money, but there's less years that you're going to be paid this money. You have to look at sort of this break-even age range, and I'll just say in general, a good sort of rule of thumb to use, and it is a rule of thumb, and it's not for everybody, but from what we've seen, it's about age 79 and a half. So that means if somebody lives past 79 and a half years old, they would have had more money from the Social Security Administration if they waited until age 66 or 67, their normal retirement age, versus taking it early at age 62. And again, that's not the end all be all there by any means. If someone needs to take Social Security at 62, we completely get that, and that's what it's there for. But if there are other assets, going back to, again, this comprehensive, financial planning, it might be wise to say, well, we can pull some money from our retirement accounts to get us through these 3, 4, 5 potential years. And when we do that, now we're just guaranteeing ourselves more money for the rest of our lives. So it's kind of like guaranteeing yourself in a way, 7 or 8% of rate of return from Social Security, which I think, a guaranteed 7 or 8%, anything right now would be more than ideal. So we're going to continue working here through Social Security and talk about working while receiving benefits. So just really quickly, in 2018, if you're making more than $17,040 and collecting Social Security and you're under your normal retirement age, you lose $1 in benefit for every $2 over the limit. So just a quick example, Bob's 63, his monthly benefit is $1,600 or $19,000 a year, but he earns $25,000 in wages. How does that calculate out? Because he's over that $17,040 by $7,960, he loses $3,980 in his annual benefit. So he still made out, right? Because he went to work and made $25,000. Yes, he lost $4,000 in the benefit, but the good news is he didn't lose it forever. And it's actually just deferred until Bob's normal retirement age. So the bottom line is, again, if you need income, early benefits are completely fine. Just make sure that you do have a retirement plan in place that can really just project these things out and see what's going to be most beneficial for yourselves and your families. And Michelle, I think that would be a good place maybe to wrap up on this portion. We can definitely take some questions right now if that sounds good.
We have a couple questions here. We'll start there. One is,
okay.
Does the age of the spouse impact the percentage of benefit?
Does the age of the spouse impact percentage of benefit? So let's just say that I'm talking about myself here, and I'm retired. Whatever my benefit is completely dependent on all of my information. It does have an effect if there is a spousal benefit that's being taken. So, for example, if there was one spouse that did not have so much earned income throughout their life that they would be better off collecting half of their spouse's benefit from Social Security, that would actually play a factor in there. But for anybody that's collecting from their own Social Security, there is no impact whatsoever on how old their spouse is, if that answers that question.
Okay. Another question. What is the best way to correct earnings records?
I wish there was an easy answer for that one. So on the SSA.gov website, there are some links on there that say, is there an error in these sort of records? And let me see if I can just maybe go back a couple slides here and see if on this page there is that direct answer. But definitely online is a good starting place. And then from there, you can always just call the Social Security Department. There are the local Social Security stations in our respective cities across New York State. I would recommend maybe trying to find one on an off day, kind of like when you're looking to go renew your license at the DMV. I would try to get into one of these places where maybe you don't see a bunch of people in there where you can ask a couple questions. But I would recommend doing a face-to-face in one of those Social Security offices. But it wouldn't be a bad idea at all to start with a phone call or just going online and going through some of those prompts to see what they need to rectify it. And sometimes it's been just, hey, sorry, we mistyped it. Technically, your numbers are right. We just put a typo error in there. And sometimes they're missing 10 years of income, which then directly has an impact on how much money someone's going to be collecting from Social Security. Okay. And it's not wrong a lot. Like, it's not wrong the majority of the time by any means. Just from when we're kind of looking at this thing, we would all think that this should just be 100% accurate all times. I'm just saying it's wrong a lot more than it probably should be. It's still very minimal in terms of that, but it's just definitely something to check on, because going back to how much money this provides to somebody in retirement, I mean, that's like, we're talking $1.5 million in some cases. That's like, again, someone retiring from, a for-profit company with $1.5 million in their retirement account. They're going to be, looking at that thing as their major retirement income stream, which again, Social Security, if you project that thing out over 10, 20, 30, 35 years, a little difference in there makes a big difference in someone's pocket. So just always good, again, to double check. And if you don't get the answer you want the first time you talk to someone from the Social Security Department, feel free just to call and ask the question again to somebody different. But that's what we want to be here for as well. So if you do think something is wrong, we're more than happy to make these phone calls with you. We can certainly, get on a conference call where, you're maybe at a off time in school or home even in the evening. We'd be happy to call and ask some questions and just try to get all the answers with you right there on the line.
Okay. And a follow-up question on the spousal benefits. Question is to clarify, if I am 63 and want to collect spousal benefits, will it be 50% of my spouse's benefits or less? So because she's less than 67, I'm assuming she's wondering if hers would be reduced or if it is actually the 50%.
Yep. So that's a good question, and that does actually depend on the spouse's age as well. So we'll say the one who is getting more Social Security. But that does hold true that if you do, no matter who you collect from, or the longer, I should say, the sooner you take it, you're definitely getting less money at age 62 than you are at 63, no matter if it's your own or collecting off of a spouse's. Every year you wait, no matter how you collect it, you are leaving money on the table if you do it early.
Okay. Here's a question. I'm not quite sure what he was referring to. It says, does that $17,040 income include pension benefits? Was that something?
Great question. It does not. So that is officially earned income. So like W-2 income. It does not include rental properties. It does not include, pension. It doesn't include, obviously, Social Security. That is real earned income. And with that said, that reduction in Social Security benefits, that is only if someone's collecting prior to normal retirement age. So someone could be 68 years old, making $200,000 a year. They're still going to get their full Social Security benefit, only applicable if you're taking it early. And the direct answer is yes, it's only earned income and does not include any sort of pension income.
Okay, another
great question.
How do you calculate the top 35 years? I'm trying to decide if I should work a few extra years. How much of a difference will it be since I make more money now? It might only be $25 a month.
So it's not going to be a major difference. Whoever asked the question, potentially, I mean, you might already be maxed out, right? You might already be at potentially the top level where it doesn't really matter if you were to make more money, because again, there is the cap on the most that they will pay out. I unfortunately just would not be able to officially give that answer of how much would be on the table there. That's something, if we did look at one of specifically that person's statement, we could help determine that. But I'm just trying to get through here. I know there is a slide that does officially have the calculation on here, and I think it's back a little bit, but that would be something that if you go on and estimate your benefits online, that's something that you can put in sort of just like you can on the New York State website for the pension, where you can kind of assume different things of when you want to retire and how much money you're making. That would be something else that you could go right on SSA.gov. And again, with Social Security, a lot of different ways to go ahead and collect this. I would always just say that would be a really good question to truly ask somebody from Social Security while they're looking at your specific situation, or we can help you while we're looking at your specific situation as well.
Okay, a couple more questions. How is Social Security taxed? You pay the same rate? I assume it is coupled with the pension, etc.
Yep, so actually that's going to be a really good question that was on some of these slides just before we stop. So I can actually go through a couple of those very quickly here. All right. Okay, so will Social Security be taxable? All right, so just trying to catch up here. So you have the ability basically to reposition assets to lower your taxable liability, but there's a whole different calculation with provisional income, and I'll kind of go through here of what this actually means, but it's your modified adjusted gross income plus tax exempt income plus half Social Security benefits equals provisional income. And let me get back to this here. So if you're looking at the filing status, whether it's a single, married filing jointly, or potentially a widowed follower, there's the base amount, the additional amount. It truly depends on how much money that you're making, of how much of it is going to be taxable. It can be taxable up to 85%. Not 85% tax rate, but up to 85% of your Social Security may be taxable. And again, unfortunately, a lot of the questions in regards to Social Security, the answer is it depends. And it really depends on each either person or household situation. So it definitely can be taxable. How it can be taxable, there are so many different calculations and ways that happens. But the answer is yes, it can be taxable, but it's not like you're paying, full federal and state taxes on it.
Okay. And a follow-up question from an earlier one. The statement says at 66.2 years, I get a certain benefit. I assume that is if I keep working until 66.2 years, correct?
So that someone's looking at their Social Security statement and saying at age 66.2 years. Yeah, most of the time what they do again is they look at how many years you have so far. So if you don't have those 35 years in, they would project that you continue to work. So on that statement, with that green statement, actually we were looking at it a couple slides back, there is an assumption built in there, which again, that may or may not be the case that actually happens for somebody. So it would assume that you are continuing to work. But again, that may not even, it may not even matter. Like if you've already put in the years that could max you out at it, it truly doesn't matter how much money you make. If it's $0 or a ton of money, that number still potentially might not change.
Okay. Are there any penalties for retiring and leaving New York State?
Are there any penalties for retiring and leaving New York State? Penalties, not from Social Security. With the New York State pension, if you live in New York State, you do not pay state tax on it. I'm not sure if that's where that question was going, but if you go to another state, you may have to pay state taxes depending on their state tax laws.
Okay, and I think looks like the last question. Can you collect benefits, then stop and restart?
You can actually, so that's another really good question. There was just a major change, and I'm trying to see here, now it's backwards. There was a major change about suspending payments, and it was back in 2015. So basically, there was a scenario where somebody could have started to collect Social Security and then defer their payments. And basically, that would assume then that they're continuing to grow when they do start to take that payment again to a higher number for the rest of their lives. So it depends on someone's age. I know as of the fact right now, you cannot file and suspend your payments anymore. So that would be, I would defer that again to a Social Security expert, and these laws are changing literally all the time. But from our experience, what we've seen when somebody does do that is that they can delay their payments or suspend their payments, in which case when they do start to take them, it just, let's just say they suspend it for a year. Talk about every year you delay taking Social Security, you get about a 7 or 8% pay raise from that now new year moving forward and forever. So the same scenario would take place there. But there was a change that, again, took place in 2015 where any file and suspending payments of Social Security could not retroactively go back and be paid. So, years ago, 3-4 years ago, and before that, we would always say, as soon as someone is 62, go to the Social Security office, file for your Social Security payments, and then suspend them. And if you don't collect until age 66, you're starting off at age 66 and what that normal payment would be at no reduction level. But if you were to file and suspend, you were able to go back and say, hey, I know I filed and I suspended my payments and I'm 66 right now. I actually didn't mean to do that. I would like to now go back as if I was 62 and get retroactively paid those, literally all 4 of those years of Social Security payments from that age of 62 until where they're at there at that lower level, and they would continue that lower level for the rest of their life. But I know that they don't do that retro anymore, but they do allow you to file and suspend payments. And again, every year or so that you delay or suspend, you get a 7 or 8% increase forever moving forward.
Okay. All right, it seems that's the end of the questions. We did have one inquiry as to whether or not attendees can get a copy of your slides, Alex. So if you want to send those to me, I can post it to the SANY site, and then we'll have the slides and the recording of this session posted at SANY.org, and we'll push it all out. Okay. Any other questions?
Great. And I know we ran through a couple of slides quickly, and especially in regards to some calculations that people did have questions on. There's a lot of that in this presentation. There's probably 10 or so more slides. Usually this is about an hour and a half presentation in some cases. So, we hit the main topics of Social Security here today, but just going back to the original piece here and then really the comprehensive view of Social Security tied into, again, New York State pension, retirement accounts, the needs that someone has in retirement, the wants that people have in retirement. It has to all be integrated with each other. And there's not a one size fits all. Hey, everyone collect at 62, everyone wait till 70, let your spouse collect first and then you collect later. There are so many things that factor into it, even outside of Social Security, literally, that could be the determining factor of how you actually maximize this benefit. Same thing again with the New York State pension and really all the personal retirement accounts and savings that are out there. So, the goal always is to get as much out of these accounts as we possibly can, hopefully do it while paying the least amount of taxes that we possibly can, and then have it last for our entire lives. So again, a lot of stuff when it comes to putting this all together, but we're happy to help anybody when it comes to their comprehensive financial plan. I know a lot of the questions that were asked today, we can definitely get more in detail with those when we're able to dig into someone's situation. So we definitely look forward to that. Please use us as a resource. We're across the entire state, and I will get with our compliance department here, Michelle, and they will send over a copy of this presentation to you.
Great. Also at saneys.org, you'll find a listing of all the exact AXA advisors that work with Saneys around the state. So you could either contact Alex or your local advisor for follow-up. So I think that's it for today. Join us next month for our Financial Friday webinar on planning for college. So hopefully we'll talk to you all then. Bye-bye.